Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, US interest rates are headed significantly higher, even though all participants are widely expecting a 25% Fed rate cut at the November meeting. On the earnings front, a little over one-third of the way through the earnings season for the third quarter. 79% of companies are beating estimates. We will compare that to history to see how it's stacking up thus far. And finally, S&P 500 snaps a 6-week winning streak this week, but not all is lost. Overall, the trend is very positive, and expectations of a soft landing remain priced in. So the U.S. Treasury two-year yield is shown in the teal on this chart, and the dark blue is the U.S. Treasury 10-year yield. So first thing you can see is that they've been trending lower over the past year, but we can see that they significantly declined in the third quarter. And after the Fed rate cut in September, we've actually seen both the short and the long end of the curve significantly rally. A lot of this is based on the expectations of market participants in that third quarter. You can see during that sharp decline in interest rates, that coincided with expectations of up to a 100 basis points of Fed rate cuts during the last two meetings of this year. We have seen expectations drop dramatically down to only 50 basis points cut. A lot of that relates to the strong labor market data. Economic data has widely been very strong, not showing any signs of forcing the Fed's hand to cut more aggressively. And inflation data that came out most recently for CPI on a monthly basis, consistently pretty steady and probably a little bit higher than the Fed would like it to see long term. Now, yield curve. We talked about this in previous weeks, how the yield curve inversion ended. It was the longest inversion in history from back in mid 2022 that ended in the third quarter. But take a look at the yield curve comparison from September 19th, the day after the Fed meeting in September, and all the way a little over 1 month later, this time, as of yesterday's close, we can see 3 month all the way out to the 20-year. You can see rates have increased across the curve and the curve is steepening. What that means is long-term rates are above short-term rates, especially when you look from 1 year out to the 20-year. Obviously, the short end of the curve, 3 months and 6 months, is pricing in those Fed cuts. But when you get out beyond 1 year, those long-term rates are increasing at a faster pace than the short-term rates. A lot of that is due to the expectations of long-term economic growth and strong expectations that perhaps long-term rates will be headed higher in the future. One note, the 10-year Treasury is at its highest level since July. Typically, we've called this the bull steepener because it's an expectations for positive economic growth. Now, in the third quarter, like I said, we are close to a little over one-third of the way through, and 79% of companies in the S&P 500 are beating their earnings estimate. This is not uncommon. We typically see estimates come down ahead of the earnings, and then they go over that bar. You can see on average, 67% is the pace. So we're above the long-term average, but you definitively see a trend in post-COVID of it being much higher, and 79% is right in line with where we've been at during the first and second quarter in 2024. So continuing that pace of a pretty healthy beat rate, but nothing extraordinary compared to recent history. Now, this is a chart of the S&P 500. First thing that jumps out, the market is in an uptrend. Okay, trends tend to go further and last longer than most would expect. And you can see this is a nice steady uptrend. We've seen the market breadth and overall momentum of the market improve. Now, the other thing, we've had 6 consecutive weeks of profits for the S&P 500 index. That streak was broken this past week, down slightly, but all is not lost. When you look at the overall equity market and interest rate market, the market is expecting 2 rate cuts by the end of the year. That will put the Fed funds rate at a target range of 4.25 to 4.5%. The market is expecting interest rates to continue lower in 2025, heading closer to that long-term Fed funds expectation of 3% or maybe even lower, depending on what the economy does. Market, when you look at a chart like this, tells us they are pricing in the Fed getting that soft landing. Time will tell over the next year, year and a half, but right now all signs point towards the Fed cutting in an environment with very little evidence of a near-term recession. So last thing, over in New Zealand, an airport had to cut it out with regard to hugging. They set a 3-minute time limit with a lot of signs around the airport in the drop-off area that says goodbye hugs in the airport needed to be 3 minutes or less. Now, I don't know about you, this may be a cultural difference between New Zealanders or even perhaps some Europeans, but a 3-minute hug is a pretty long hug. And what they recommend is that if you need to hug somebody for longer than 3 minutes, go to the long-term parking area to do that. So they're offering an opportunity to hug longer in a different place, just not the drop-off area. I think 3 minutes I think that's fair. I think that's fair. So with that, I want to thank everyone for watching, and I'll see you next time.